Hello, this is Tommy Patterson, the B.A.L.D mortgage guy, and today we're going to talk about self-employed borrowers and what it takes for them to get a mortgage. Traditional W-2 wage owners are generally able to qualify for a home loan by simply providing copies of their W-2 tax returns and verifying that they have a job. But when you own your own business, things can become a little more complicated. In this video, I'll break down some of the general requirements in place for self-employed borrowers to qualify for a home loan. You will want to chat with me to find out more specific loan programs that I might have available, but as a general rule, let's dive in on what you need. We will begin with an especially important rule, and that is verification of how long you've been self-employed. Most lenders and loan programs require that you have been self-employed in your current business for a minimum of 2 years. Let's define what self-employed is. A self-employed person is someone who has ownership of at least 25% or more in a business and one who is not a W-2 employee. However, there are exceptions to the 2-year rule. You might just qualify with just 1 year of self-employment if you can show a 2-year history in the same line of work. You'll need to document an equal or greater number of value in income compared to the W-2 position. Some lenders will even count 1 year of related employment plus 1 year of formal education or training as an acceptable work history. If you've been self-employed for less than a year, more than likely you will not be able to qualify for a mortgage. If you meet the self-employment history requirement, the next thing that your lender will take a look at is they're going to require you to furnish 2 years of tax returns. This is where most self-employed borrowers throw up their hands and say, I don't have 2 years of tax returns, or I don't have a lot of income. Don't throw in the towel yet. There are other programs available for self-employed borrowers, such as the bank statement program. The next item I'll talk about in this video is self-employed borrowers' income. Mortgage lenders will generally consider any source of income that is stable, consistent, and ongoing. That means all kinds of self-employment income is eligible for mortgage financing, including, but not limited to, business owners, freelance income, contract work, seasonal work, gig work, side jobs. These types of incomes can be considered on their own or as additional funds on top of a primary income source. Lenders can also count unemployment income for contract or seasonal workers with a regular documented history of receiving unemployment in the off-season. For any source of income, a lender must determine if it's ongoing. Generally, this means income seems likely to continue for at least 3 years after closing. A history of declining income will not improve your chances with a mortgage lender. For self-employed borrowers, a lender may conduct a review of the borrower's business to determine its stability and likelihood their income will continue at the same level. If you're in a declining industry, such as a hotel during a coronavirus pandemic or a builder during a housing crash, this could pose problems with your approval. Underwriters use a somewhat complicated formula to come up with a qualifying income for self-employed borrowers. They start with your taxable income and add back certain deductions like depreciation, since that is not an actual expense that comes out of your bank account. Business owners and other self-employed workers often take as many deductions as they can. While this can save you a lot of money on tax time, it can also hurt you when it comes to your mortgage application. There are many new bank statement programs available today. These are the 12 and 24 month personal bank statement program and the 12 and 24 month business bank statement program. So how will we document your income? In most cases, we'll ask you to provide the following documents to prove your income to us. 2 years of personal tax returns, 2 years of business tax returns including schedules K1, 1120, 1120S, business license, year-to-date profit and loss, balance sheet, signed CPA letter stating you are still in business. These documents can be prepared by a certified public accountant or tax preparer. If the business is a sole proprietorship, not a partnership, corporation, or S corporation, you may not have to provide business tax returns. If you've been self-employed at the same business for 5 years or more, you may only have to provide 1 year of business and/or individual tax returns instead of 2. If your income is not regular and reliable, lenders won't count it. However, many businesses go through ups and downs. You should also prepare to explain any significant year-over-year decrease in income when you apply for a mortgage as a self-employed borrower. You don't have to own your own business to be considered self-employed. We will consider you self-employed if you own 25% or more of a business, you do not receive a W-2, You receive 1099 tax forms. You're a contractor or a freelancer. At least 25% of your income is from self-employment. Most of your income is from dividends and interest. If you're part owner of a business but your share is less than 25%, you're not considered self-employed for home loan purposes. And remember, you're not required to report self-employed income under Fannie Mae and Freddie Mac's lending rules. If you have a freelance job or a small business on the side and you don't need the income from it to qualify, your lender can ignore it on your application. Thanks for watching. This is Tommy Patterson, the B.A.L.D mortgage guy. Please reach out to me at tommy.patterson@homestarfc.com, and my phone number is 770-654-8599. Have a great day.